So the topic for today is tax planning for capital gains and some interesting issues relating to the same. Now, when Akshat bhai had spoken with me a few days back, and we were discussing as to what topic to think about when it comes to Indian income tax, I was just reminded of this beautiful quote by Albert Einstein. And Albert Einstein says, and everybody knows what a great scientist and thinker he was. And he says that the hardest thing to understand in this world is income tax. So, if somebody like Einstein is saying something like this about income tax, then we need to make sure that as tax professionals, we not only dissect it, but also understand it in a manner where, we can implement it better and we can give useful tips and planning for our clients. But as happens with all great scientists, they give you a problem and they also give you a solution. So Einstein further goes on to say, and I'll use one of his another quotes, he says that when something is too difficult, imagination becomes more important than knowledge. So then it's not always about what is out there, it is about reading between the lines, it is about thinking out of the box, it is about using some smart planning tips and ensuring that one and all gets the best out of this particular subject. So I'll straight away come to this aspect of capital gains, and the reason why मुझे लगता है कि ये one of the more important topics in income tax है, क्योंकि कैपिटल गेन्स ऐसी चीज है जो आप प्रोफेशनली भी यूज करते हैं आपके क्लाइंट्स को एडवाइस देने के लिए, और आप पर्सनली भी आपकी खुद की निजी जिंदगी में भी आपने कोई प्रॉपर्टी बेची, आपने कोई एसेट खरीदी, तो वो सब कॉन्टेक्स्ट में भी कैपिटल गेन आप यूजफुली रिलाय और सेव कर सकते हैं. So let's start with, I would just like to briefly explain what exactly is capital gains, or what are the two essential elements of capital gains. So there is section 45 of the Income Tax Act which defines capital gain, and it says that there are two important elements. The first element is that there has to be a transfer, and there has to be a transfer of a capital asset. So the golden rule over here is that for anything to be liable or subject to tax under the head capital gain, two elements are essential: transfer and capital asset. So as I have just put it as a form of an example, सब मेंबर्स जानते हैं कि if you are talking about rural agricultural land जो अपने prescribed limit से बाहर आती है, तो आप सब जानते हैं कि वो एग्रीकल्चरल लैंड पे कोई कैपिटल गेन टैक्स आप उसको बेचोगे तो नहीं लगता, बिकॉज इट विल बी कंसिडर्ड एज अ ट्रांसफर, पर वो कैपिटल एसेट की डेफिनेशन में नहीं आती. Similarly, if you have items which are used as personal effects, then again it is an exception to the definition of the term capital asset, and therefore when you transfer those items or sell them, it will not be considered as capital gains. अगर हम ट्रांसफर की बात करें तो if you are giving something as a gift which is to a relative whose definition is prescribed under the act, then we all know that in that case it is an exception to transfer. If we receive something by way of inheritance or succession, again we know that it is something which is an exception to transfer, and therefore these are the instances which just give us the background that for anything to be chargeable under the head capital gains, both these elements need to be present, and if just one of them is present, it will not be considered as an incidence liable to capital gain. Now let's go to the next aspect, where I would straight away like to come to some computation aspects and interesting issues relating to computation of capital gains. Now section 48 of the Income Tax Act provides the mode of computation of capital gains, and it says that there are two important aspects when we have to talk about computation of capital gains. Consideration जो हमारा होता है उसमें से दो चीजें हम डिडक्ट कर सकते हैं. One is what is known as expenditure wholly and exclusively in connection with the transfer. हालांकि हमारी जो स्टैंप ड्यूटी होती है, रजिस्ट्रेशन चार्जेस होते हैं, लीगल फीस होती है, ब्रोकरेज होती है, ये सब चीजें हम कंसिडरेशन में से डिडक्ट कर सकते हैं, बिकॉज दीज आर एक्सपेंडिचर incurred wholly or exclusively in connection with the transfer. And the second important part is of course the cost of acquisition or cost of improvement. जो हमारी cost of acquisition या index cost of acquisition होती है, वो भी हम mode of computation में से deduct करते हैं. With respect to this particular aspect, there are a couple of important decisions which I would like to mention over here. And Akshat bhai, whenever we talk about the subject of capital gains, over the years through judicial interpretation, it has really evolved. And therefore, I would like to highlight some important decisions which laid out nice principles relating to tax saving under the head income from capital gains. So when we talk about one of the decisions, a decision of the Delhi High Court in Mithilesh Kumari. Now here what had happened is that the taxpayer, she had taken a loan from her mother and she was making interest payments to her mother or mother-in-law on that loan. She sold the asset and she said that I would like to add this interest payment which I have made to my mother-in-law for purchasing this asset in the deduction which is allowed from the consideration received. And there the Delhi High Court favorably held in the favor of the taxpayer, saying that yes, definitely interest paid on loan for acquiring a capital asset is surely deductible and you can do so. Another interesting case is of the Karnataka High Court, where the High Court said that they meaningfully referred to the decision of the Delhi High Court in Mithilesh Kumari, but they said that if you have already taken a deduction for an item which is interest in this case under another provision of the Act, and as my professional friends are aware, interest paid, there are provisions or income from other sources where interest is deductible. So if I have already claimed that interest under section 57, I cannot take a double deduction again in respect of this particular interest item. So this is something which is again to be considered. Another two interesting points over here is that a lot of time it may happen कि हमें कोई एसेट पे एनकम्ब्रेंसेस है, वो मेरी एसेट है जहां पे कोई टेनेंट रहता है, मुझे उसको एविक्ट करने के लिए, क्योंकि अगर जब तक टेनेंट को मैं एविक्ट नहीं करूंगा वो एसेट मैं बेच नहीं सकता. तो ये सब जो कॉस्ट मैं इनकर करता हूं, तो कोर्ट्स ने कहा है कि ये सब कॉस्ट भी मैं मेरे कंसिडरेशन में से मोड ऑफ कॉम्प्यूटेशन अंडर सेक्शन 48 में डिडक्ट कर सकता हूं. एंड दीज आर आल्सो आइटम्स ऑफ एक्सपेंडिचर which will be allowable as a deduction. So I have just mentioned the case of Shakuntala Rajeshwar, which is again a Delhi High Court case, and one of the other cases of the Bombay High Court in Abrar Alvi. ये केस में ऐसा हुआ था कि फादर और सन के बीच में प्रॉपर्टी का डिस्प्यूट था. फादर को वो प्रॉपर्टी बेचनी थी, सन ने उसके सामने लीगल अटैचमेंट किया कि ये प्रॉपर्टी मैं आपको नहीं बेचने दूंगा. Matter went to the court. The father incurred legal expenses to remove this encumbrance. The court said that this is something which is allowed as a deduction by computing under section 48. Moving on to certain planning aspects, I would like to take upon a very interesting issue, and this is something which a lot of our professional friends can meaningfully use. We all know that there are exceptions to transfer which are laid out under section 47 of the Income Tax Act. मैंने जैसे कि आपको बताया था मेरी पहली स्लाइड में कि अगर आप गिफ्ट की बात करें to relatives, so that is an exception to transfer. Similarly, any asset received at the time of the partition of the HUF is also an exception to transfer under the provisions of section 47 of the Income Tax Act. So let us take an example where I can strategically use the planning prior to the sale of the HUF property by doing a partition of the HUF. So say for example, friends, there is an HUF where there are 4 brothers, A, B, C and D. उन्होंने HUF के नाम पे एक HUF ने प्रॉपर्टी ली थी जिसकी इंडेक्स कॉस्ट ऑफ एक्विजिशन आती है 12 लाख रुपए. आज की मार्केट वैल्यू जो वो HUF प्रॉपर्टी की है वो 1 करोड़ रुपए है. तो जैसे कि आप जानते हैं और हमने सेक्शन 48 की बात की, अगर HUF आज ये प्रॉपर्टी बेचने जाता है तो कितना गेन होगा उसको? 88 लाख रुपीस, क्योंकि 1 करोड़ मार्केट वैल्यू है, 12 लाख रुपए इंडेक्स कॉस्ट ऑफ एक्विजिशन है. तो 88 लाख रुपीस पे एचयूएफ के हाथ में इनकम टैक्स लायबिलिटी एज लॉन्ग टर्म कैपिटल गेन्स आएगी। मान लीजिए यही चीज को मैं पहले पार्टीशन ऑफ एचयूएफ करता हूं और चारों मेंबर को ये प्रॉपर्टी 1/4 जाती है और फिर ये मैं प्रॉपर्टी बेचता हूं, तो भी उस केस में मुझे 88 लाख की लायबिलिटी आएगी, क्योंकि 12 लाख का चौथा भाग यानी 3 लाख होगी मेरी कॉस्ट ऑफ एक्विजिशन और 25 लाख होगी मेरी कंसिडरेशन। सो 22 लाख पर मेंबर विच इज अगेन 88 लाख ऑफ कैपिटल गेन्स। तो आप मुझे पूछेंगे तो इसमें प्लानिंग कैसे करें? तो this is something which you can smartly do when you do the partition of the HUF prior to the sale of HUF property. What you would do is you would partition this HUF where A, B, C and D will receive 1/4 share in the property. A will tell B, C and D कि भाई आपकी ये प्रॉपर्टी का 1/4 हिस्सा आज की तारीख में 25 लाख रुपए का होता है, क्योंकि 1 करोड़ से डिवाइड बाय 4 करोड़। मैं आपको 25 लाख 25 लाख 25 लाख ऐसे करके ए जो है वो बी, सी और डी को 25-25 लाख दे देता है जो उनको मिलने का था। वो 25 लाख पे बी, सी और डी को तो कोई टैक्स लगेगा नहीं, बिकॉज दे आर रिसीविंग दिस एज पार्ट ऑफ द पार्टीशन ऑफ द एचयूएफ। सो बी, सी एंड डी डू नॉट incur any tax liability when they receive this 25 lakhs each on this HUF property which has now been partitioned. A will very interestingly get a step up in his basis. His original index cost of acquisition was 3 lakh rupees, which was 12 lakhs divided by 4. Plus, he will be getting 25 lakhs, 25 lakhs and 25 lakhs, which is another 75 lakhs added to his 3 lakhs of original cost of index cost of acquisition. So his cost of acquisition will be 78 lakh rupees. And he will then be paying tax on only the remaining amount, which is 1 crore minus 78 lakh rupees. So on 22 lakh rupees instead of the HUF or the members together paying tax of 88 lakh of rupees. So simply by partitioning this property prior to the sale and one member acquiring the interest of all the other 3 members, in the entire planning, nobody is getting anything less than what they should receive, but you are as a family saving tax, because instead of paying 88 lakhs of capital gains and the long-term tax thereon, now the capital gains is only 22 lakhs and the long-term tax thereon is to be paid. This planning has also got the High Court's seal of approval, because this is something which is now given a judicial blessing. So I've just mentioned 2 important Gujarat High Court decisions, the case of Narendra Chauhan and Lalitaben Hariprasad, where similar planning was done and the High Court said that this is absolutely perfect and you can meaningfully plan this to save your tax from 88 lakhs to 22 lakhs of capital gains in this particular example. Moving forward, another very interesting section, and I'd like to spend a little bit of time on the slides relating to this particular section, is section 49, special modes of acquisition. आप सब जानते हैं friends कि a lot of times it happens that I would receive a property by devolutionary means, जैसे कि distribution of assets on partition of an HUF, either under a gift or a will, or by succession or inheritance. उस केस में क्या होता है कि when I receive this property by a special mode of acquisition, my cost of acquisition तो कुछ है नहीं, क्योंकि मैंने तो 1 रुपया भी नहीं दिया ये प्रॉपर्टी को खरीदने में. So the question arises is what will be considered as my cost of acquisition? Again the issue arises is कि मेरे को तो ये प्रॉपर्टी डिवोल्यूशनरी means से आज मिली, जिससे ये प्रॉपर्टी मिली है उन्होंने ये प्रॉपर्टी 2 साल 4 साल 20 साल पहले ली हो सकती है, तो मेरा पीरियड ऑफ होल्डिंग उसमें क्या होगा? So here there are 2 important sections. One is section 49 clause 1, which says that the cost of acquisition of the previous owner will be deemed to be the taxpayer's cost, and the period of holding of the previous owner under 242 capital A, which defines short term or long-term capital asset, or rather what is the definition of the term as capital asset period, उसमें ये कहते हैं कि period of holding of the previous owner will also be included in calculating the period of holding of the taxpayer. So again, these two provisions will become very important when we talk about section 49 devolutionary means. And now let me take one or two interesting case laws where even after using these provisions, issues arose as to how indexation should be done and how the courts had meaningfully resolved this. Can I just request our admin to give me the yellow cursor on my screen so that I can just take it to the grid level, and right now it's on Akshat Bhai's screen. If it's possible, otherwise I can continue, not a problem.
I have given the controls to you. You are able to do that?
Yes. Yeah, I think this is fine. Perfect.
Yes. Fine.
Okay. So let's talk about, the question where, you receive a gifted or an inherited asset, and you are to consider what will be the cost of acquisition for this particular asset. So as we all know, friends, under clause explanation 3 of the proviso under section 48, index cost of acquisition has been defined. And I would just like to read with some highlighted part very quickly. They say that index cost of acquisition would be that amount which will bear to the cost of acquisition the same proportion for the year in which the asset is transferred, and this is important, bears to the cost inflation index for the first year in which the asset was held by the assessee. Now take an example where I receive an asset from my grandfather. The grandfather had acquired this asset in 2001. He passes it over to me under his will in 2020, and I want to now sell this asset in 2020. The department took a view that in this particular case, the cost of acquisition of the grandfather would transfer to me. So they said that is not a problem. They said that the period of holding, which is from 2001 to 2019 of the grandfather, would also transfer to me, which is again fine. So they said it will be long-term capital asset. But when it came to the index cost of acquisition, they took a view that the indexation will be calculated from the first year in which the asset was held by the assessee, which is me. So they said that when you talk about the denominator and the numerator, it will both be 2019 and 2019, or 2020 and 2020. And therefore, the index cost of acquisition benefit really does not accrue in this particular instance. Now, this is where the case of Delhi High Court, Bombay High Court, and now meaningfully followed by the Gujarat High Court comes into picture. The landmark decision in this particular case was that of Manjula J. Shah. In this particular case, the Bombay High Court held that when you talk about passing of the cost of acquisition and the period of holding, 48 proviso explanation 3 cannot be read in a narrow manner where index cost of acquisition of the previous owner will not pass on to me, and therefore the court held that if the grandfather had sold this, he would have received the index cost of acquisition starting from 2001. Therefore, if I sell it today, I should also get the indexation benefit starting from 2001. And that is where the principle was meaningfully laid out, was followed by Arun Shuglu, Gautam Amin, and Rajesh Vittalbhai Patel. So these are some important cases or decisions when it came to section 49. Let's talk about quickly section 50 and depreciable assets. Now we all know that there is a provision in the Income Tax Act under section 50 which says that whenever an asset has been used for the purpose of business, whereby depreciation has been claimed under section 32 of the Income Tax Act, whenever I transfer such depreciable asset, there will be a deemed recharacterization of that gain, and the gain will be taxable as short-term capital gain. This is in essence the provisions of section 50 of the Income Tax Act. Then comes the important question is, as you all know, and I'll be talking about in my further slides, what if I want to take the benefit of the section 54 family? We all know that under 54 EC, I can buy capital gain bonds. Earlier, I could buy it for any other asset. Now I can do it only for land and buildings. So of course, since land cannot be depreciable, I have said for buildings, I can use 54 EC. And I can do the 54F planning, which is for any other asset, for all depreciable assets, including building. So the question comes is, can I avail of this planning by saying that the nature of the asset was otherwise long-term? Although if I had to pay tax, the characterization would be deeming, and I had to pay tax as a short-term capital gain. So there I have cited a couple of decisions. The pioneer decision in this particular case was Assam Petroleum Industries, where the Guwahati High Court said that nowhere does the section talk about the asset being per se long-term or short-term. They say that the nature of the asset always remains what it is. Section 50 is only a section where if you were to pay tax, there will be a deeming provision which will be applicable where the tax will be paid as short-term capital gain, and therefore if I have to say that I don't want to pay tax and I want to plan under 54 EC or 54F, because the nature of the asset still remains long-term, I can still do it, and therefore the Assam Petroleum was meaningfully then followed. The controversy is now settled under Ace Builders and two decisions of the Gujarat High Court for all my professional friends belonging from Gujarat, Himalaya Machinery and Aditya Medicines. Now I would like to come to one important aspect when it comes to planning and capital gains, and this is an important exemption. So I would like to give a lot of decisions when it comes to this particular sections. There are two important sections. One is section 54 and the next one is section 54 capital F. Now friends, we are all aware that the benefit of this capital gain tax exemption is available only for an individual or HUF. It is available only in respect of a long-term capital asset. We all know that there are conditions which are prescribed for purchase, which is 1 year prior or 2 years after the date of transfer of the asset. If it has to be construction, the construction has to be completed within 3 years from the date of transfer of the capital asset. One important distinction is that section 54, which is house against house, talks about investment of capital gains, which is only the gain component. If I'm taking an exemption under section 54F, which talks about any other asset other than the residential house, which would include piece of land, jewelry, ornaments, shares, and others. In that particular case, my professional friends would know and should take note that instead of investing the capital gains, the section requires or expects that the entire net consideration should be invested in this particular case. So this is again an important provision, and of course there are certain descriptions prescribed. Let's straight away go to some important cases and how over a period of time the judicial analysis has evolved when it comes to exemption from capital gains. So say for example, a lot of times it may happen that I have purchased a house, a residential house, but it is not up to my requirements, and it's an old property and there will be substantial modifications which will be required to be made to that particular asset. So what I do is I also do construction on that particular house after purchasing the asset. So I have done part purchase and part construction. So now the question arises is, can I take the benefit of section 54 where there is part purchase and part construction? The department took a view that either it should be purchase or it should be construction. So in the case of BB Sarkar, the Calcutta High Court very nicely said that nowhere does the section say that it has to be either purchase or construction. It says that I can do both as well. I can do purchase part and part construction. It cannot be just one of the two. And therefore, if I have purchased a property and done significant modifications by adding things by further construction on that property, part purchase, part construction is allowed. Let's take another case where I have started construction of the asset prior to the sale of this particular asset. So let's take a case where I sell the asset on January 2019. I want to invest the capital gain of the asset in construction of a residential house, the construction of which I had already started in July 2018. So now the question arises is, can I start the construction prior to the sale of the asset or prior to the transfer? Again, the court said that in the section itself, the only condition prescribed is the construction should be completed within 3 years from the date of transfer. There is no embargo on when the construction should or could have started. So the answer is that you can even start the construction prior to the sale and invest the capital gains into that particular property. Again, it may happen, and this is, Gujarat High Court case has come up. So in a lighter vein, I would just like to mention to all my professional friends, and I'm sure all of you practice this across the country as well. Whenever it comes to a Gujarati, they always try and find ways and means to, save their tax. So in this particular case, it's a very interesting case. The taxpayer was a lady. She had 2 residential houses. She used to live in one of the houses with her husband and son. That house was owned 50-50% by her husband and son. She sold one of her other residential properties and bought a 15 or 20% interest by investing that capital gains into the residential house where she was already living and which was owned by her husband and son. So the department said that no, this is not allowed because you are already living in the house where you are now purchasing the interest. The Gujarat High Court said that, well, all the condition states is that you have to transfer the asset, invest the gain in acquiring another residential house. So as long as the other conditions of section 54 or 54F for that example are complied with, it is absolutely okay to do so. Again, there is another case of a Madras High Court where similar facts pattern were there. I'll not go into it, but I have cited that. One case which is very important, and it's a recent case of 2018. Here, please pay attention because this is applicable to a lot of us across board because this is where the numbers matter a lot. This is a case of the Madras High Court where the facts were that the taxpayer had purchased a piece of land 3 years prior to the transfer of his asset. He had, let's say, purchased the land for 2 crores of rupees. He sold a piece of land for 4 crores. And now he wants to use the entire net consideration for investing in this particular house. Now, if you know, when we talk about construction cost versus land cost, significant amount of cost would always be for the land and construction would be reasonably lower cost compared to land. So in this particular case, let's say I have done construction worth of 2 crores, which I'm doing post the transfer, on a piece of land bought for 2 crores prior to the sale, 3 years prior to the sale. The question comes is, can I claim exemption for the full amount, which is both the land as well as the construction? Here the Madras High Court said that yes, as per the provisions of 54 or 54F, there is no embargo in this particular instance, and as long as I meet all the other conditions, I can take the entire value, which is land as well as construction, notwithstanding the fact that the land was purchased a few years before the transfer of the asset, because the court said that the condition is that the construction should be completed within 3 years. And therefore, this is an important case because a lot of times we may come across facts where the land was purchased before and there is significant value attached to the land. Again, a few interesting cases where I have sold multiple houses and I want to buy multiple houses against that. Yes, they say that if I have sold 3, I can buy 3. Of course, what I cannot do is I cannot sell 1 and buy 3. So if there are multiple sales, there can be multiple purchases. Rajesh Keshav Pillai. Another interesting case where I have sold shares and I keep selling the shares every year. So let's say I sell shares in year 1, I sell shares in year 2, and I sell shares in year 3. And I pool the entire gain of these 3 years and I use it against the purchase or construction of a particular house. Here also, the Bombay ITAT in Ajit Anga Panekar has said that yes, you can do so because ultimately you are pooling the gain of multiple years into investment into one house. So again, this is a very useful decision. There are other decisions where it may happen that I may have invested the entire amount, but for whatever reason, the registration of the purchase deed may not have happened, or there may have been some slight delay in construction. The courts have said that yes, we would beneficially want to interpret the section, and therefore those cases are also there. A case of the Kerala High Court where I had borrowed funds to purchase or construct my house, and the capital gain funds which I received, I put it in a deposit in the bank. Again, the court said that what is wrong with that? Ultimately, it is not the same funds which have to be used, and therefore this was meaningfully done. I can also take multiple section benefits. So if I have sold a property, or let's say a piece of land, I can make the 50 lakh investment under 54 EC bonds, and I can also use the 54F exemption for construction or purchase of a house. I can use a cocktail of the 2 sections that is also available. What is unfortunately not permissible, and there was a meaningful amendment which came about. Earlier, the language of section 54 or 54F talked about a residential house, and therefore a line of judicial thoughts had taken a view that a does not mean singular. So if I had sold 1, I could buy 2 or 3 or 4, which in my view was not the right approach or the right line of thinking. They changed the section from assessment year 2015-16, where they now say that it has to be 1 residential house and not a residential house. However, the second point is important because even after the amendment, I personally believe and of the strong view, and there are a few judicial decisions to support this as well, that if I have taken adjacent units, let's say 101 and 102, I have broken the wall in between, made it into 1 residential house, which is adjacent or contiguous units, then in that particular case, I firmly believe that you can still be entitled for this exemption because I can classify it as 1 composite residential house, which is 101 and 102 together, even though for practical purposes, I may have done 2 separate sale deeds or rather purchase deeds in my case of this particular property. Option to purchase or construct 2 residential houses under this special one-time exemption, which was brought in from Finance Act 2019. Finance Act 2019, and Piyush Goyal was the interim finance minister for that particular vote on account budget which came about. In that particular budget, it was proposed that if a taxpayer has capital gain of up to 2 crore rupees, then for a one-time exemption which he can take during the lifetime, he can buy 2 properties or up to 2 residential houses from that capital gain. So it means that if I have a capital gain of 1.8 crores, I can buy one property in Ahmedabad and one property in Kashmir or Srinagar for that matter, and I can meaningfully use the capital gain because the amount is less than 2 crores. Of course, as I mentioned, it is an option given to the taxpayer, but it's only a one-time benefit which is granted to the taxpayer. Another issue which may arise at times is that, as we all know, friends, there is a scheme which is the capital gain account scheme, which says that if I am not able to invest my capital gain under 54 or net consideration under 54F in the purchase or construction of the property by the due date or by the date of furnishing of the return, then in that case, I can invest that amount into capital gain account scheme, and then within that period of 2 years or 3 years as the section prescribes, from that account use the money for purchase or construction of the property. Now in this particular case, the issue would come is whether the due date would be as per the provisions of 139(1) or 139(4). Take for example a case where a property was sold by somebody in February of 2020. As we all know, the due date of furnishing of the return under 139 would be July 2020. If by July 2020 he is not able to put this money into the capital gain account scheme, the question arises is what could happen? In these particular two decisions of Jagtar Singh, which is the Punjab and Haryana High Court, and Shankarlal Saini, which is the Rajasthan High Court, the courts took a beneficial view where they said that no, we will not look at July 2020, but rather March 2021, which is the date of filing or furnishing the return under 139(4). I'll not spend a lot of time, but just wanted to mention that in cases where these kind of scenario may arise, one can meaningfully sometimes try to, I would say, take shelter by using these meaningful judicial decisions. Let's go to 54 EC. This particular section benefit, as we all know, is available not only to the individual and HUF, but it is available in the case of all taxpayers, so all persons for that matter. 54 EC, as we all know, is the investment in capital gain bonds. The conditions are very straightforward. I really don't need to spend much time, but I'll quickly mention you have to invest within a period of 6 months from the date of the transfer. Till about 2 years back, you could make investment on transfer of any asset. Now they have restricted it only for land or building or both or either of the two. So if I sell my shares or gold or jewelry for that matter, I can take benefit of 54 capital F, but I cannot take benefit of 54 EC. The aggregate investment is capped to a maximum of 50 lakhs. And then they have prescribed the bonds of the highway authorities, electrical corporation, or the Indian Railway Finance Corporation, the 5-year bonds. Then comes a few interesting decisions on particular section 54 EC, which is the capital gain bonds. Now, a lot of times it may happen that I have received the advance money as per the agreement to sale, and I invest that advance money into the capital gain bonds, but the sale deed has not yet been executed. So can I take benefit under 54 EC? The department took a view that the language says that within 6 months from the date of transfer. So unless the sale deed has been executed, we will not allow this amount to be invested as considered valid. The court said that you cannot take a narrow myopic view of a beneficial provisions which has been provided, and therefore in the case of Bhikhulal Chandak, which is a Nagpur ITAT case, and Rahulji Patel, which took a similar rationale or approach, they said that even for advance received under agreement for sale, investment under 54 EC will be considered valid provided the other conditions of the section has been met. Again, it may happen that the bonds may be purchased not only in my own name, but jointly with another family member. The courts held that as long as I am fulfilling all the conditions, that itself cannot be an embargo, because it's not that it is purchased only in their name. I am also a joint holder in this particular thing. And then another interesting case of the special bench of the Ahmedabad ITAT, where the question arose is, and I'll give you by way of an example. Say, for example, I have sold an asset on 3rd of February 2020. Now, as per the conditions of the Section 54 EC, if we take a look at a period of 180 days, then from 3rd February, it will be 2nd of August, by which I will be required to make this investment into the capital gain bonds. So the question came before the Ahmedabad special bench was, does the month as referred to in the section refers to a period of days, or month as is understood under the General Clauses Act? So the special bench took a view that in this particular case, we will understand month as per the provision of the General Clauses Act, which means that you will consider the period of 6 months from the last date of the month in which the transfer has occurred. So instead of 3rd February to 2nd August, I will start this period of 6 months from the end of the month, which is starting from 29th February, and therefore I will get time all the way up to 31st August to make this particular investment. So this, my friends, it becomes useful where sometimes, the dates have been missed out by the taxpayer. Instead of 180 days, you have to calculate 6 months or 6 calendar months for that particular instance. One of the topics which I'd like to talk about and spend some time again on is tax planning for capital market transactions. And Akshat bhai, we all know that, in today's uncertain economic scenario, everyone's eyes are on the capital market or what's happening in the market. I'll not go into the economy or the markets, but let's just quickly come to a few important tax proposals, especially which are in force when it comes to taxing of capital market transactions. So as we all know, friends, there was a point of time till assessment year 2018-19 when if there were STT paid shares and you had held them for more than a period of 1 year, then in that particular case, they were considered as long term and there was no tax because there was complete exemption under Section 10, Subclause 38 of the Income Tax Act. Then from the assessment year 2019-20, Section 1112 capital A was introduced. It's a new section which was introduced in the Income Tax Act, whereby such gains started becoming taxable at long term at a special rate of 10%. And there they said that we will give you an exemption up to 1 lakh rupees in respect of such long-term capital gains, because we don't want that if you are having gains up to 1 lakh, you should be paying this 10% tax. And we are also aware of a similar provision which already used to be there under 111 capital A in respect of short-term capital gains where the rate of tax was 15%. So now we are talking about the 10% tax and the 15% tax. Here, my friends, the important aspect arises is that what do I do with respect to this particular section? I'd just like to mention to my professional friends that as you are all aware, they came out with a date of 31st January 2018, where they said that the value of the shares as on that date can be considered meaningfully or beneficially by the taxpayer as his cost of acquisition. And tomorrow, if he sells the share, only the difference between the current value and the value as on 31st January 2018 will be considered as subject to 10% tax. So I'll quickly take an example. Let's say that in 2015, the shares were purchased for 1,000 rupees. The 31st January 2018 value of the shares is 3,000 rupees. And today, if I were to sell these shares, let's say for 4,000, my gain will only be 4,000 minus 3,000, which is the 1,000 rupees taxable at the rate of 10%, and that will be the tax which will be payable on this particular transaction. Again, the question or again the useful provision over here is that up to rupees 1 lakh, there will be complete exemption. So if my gain is within that 1 lakh rupees, there will be no tax at all at the 10% which will be liable to be paid. Now let's talk about a few interesting tips when it comes to making the most out of your capital gain tax planning. Now, as we all know, in the case of a resident taxpayer, whether it's a long-term gain of the market or a short-term gain of the market, the entire gain can be absorbed into the basic exemption limit. So if your gain is within the 2,50,000, which is the basic exemption limit for a resident individual who's having a normal age, then in that particular case, you don't have to pay any tax. However, the important part over here is that with respect to LTCG or STCG of the market, unfortunately, you cannot rely on the provisions of deductions provided under Chapter 6A, which is one of the biggest ones, is obviously the ATC deduction of 1,50,000. So if I were to give you an example, if you had income from other sources, which was 1 lakh rupees, short-term capital gain, which was 1,20,000 or rather 2,20,000 rupees, then in this particular case, the 1,50,000 of ATC deduction can only be used against the income from other sources. The extra 50,000 cannot be used to reduce your short-term capital gain, because for those two provisions, Chapter 6A deductions are not allowed. Therefore, you should plan them wisely if you are only having gains from the market. Fully enjoying your Section 112A deduction. Now, friends, a lot of times till this particular section was there, because 1038 used to completely exempt the capital market long-term gain, we were of the view that there was no requirement for us to plan our share or mutual fund portfolio into multiple hands. Now, because this 12%, the 10% flat rate of tax on long-term capital gains is there, we need to ensure that all, or it would rather be worthwhile considering that all the members of the family who are major are having the demat account, as well as the HUF is also having the demat account. Because to give you a simple example, in one individual's case, the limit of the exemption under 112 capital A is 1 lakh rupees. Just imagine if the portfolio was spread between 4 or 5 members, straight away the 1 lakh limit becomes 4 lakhs or 5 lakhs, because it is 1 lakh for each individual who will be able to meaningfully take this. So you are straight away increasing the planning that you can do by just spreading your portfolio into multiple members of the family. And also an important point which I've used in the last bullet, you can even decide to roll over your capital gains and meaningfully step up your cost of acquisition. Say for example, I'll take this scenario where I'm holding 50 shares of a particular script. The value of those shares on 31st January 2018 is 2,000 rupees. So 2,000 into that 50 comes to that 1 lakh, which is the basic exemption limit, which is permissible. Now the value of the shares is much more than that. So what I do is, for that particular year, I use my step up by taking benefit of the 1 lakh shares. I want to hold on to that script. I simply sell that script, utilize that gain, and say that it is within that 1 lakh. And now my new cost of acquisition would be the current market value. So tomorrow or after 5 years, if I were to sell those shares, it will not be value as on 31st January 2018. It will be value as on today, which is now, and I'm ultimately getting a step up in the basis. I'm meaningfully utilizing the 1 lakh of exemption, which is available to me every year, and I'm simply doing a rollover of my capital gains. So again, this is something which can be meaningfully considered for taxpayers. Always remember, you need to think out of the box, and these are the last 1 or 2 slides that I'd like to talk about, because I'm approaching the time of around 1 hour, and I'll be happy to take any questions which our viewers or members are having. So when we talk about tax planning and some smart out of the box thinking, basically, friends, one point which I'd like to mention over here is that when it comes to the rebate, and we are all aware that there is a section 87 capital A which provides for a rebate of a maximum of up to rupees 12,500. When we talk about section 111A, which is gain on short term of market transactions, and 112, which talks about the normal long term capital gains, in both these sections, there is room open to meaningfully utilize the rebate of up to 12,500 under section 87 capital A. The reason for this is because these are erstwhile, or these are sections which were already in existence, and therefore the rebate reference which have been made under those sections is with respect to section 88, which was an erstwhile section, and not with reference to section 87 capital A. So I can meaningfully take the rebate for those 2 sections. However, as far as this new provision under 112 is concerned, where I'm talking about, 112 capital A is concerned, where I'm talking about the 10% rate on tax of STT paid long-term capital, long-term market shares. Unfortunately, the section itself provides an embargo, and there is no possibility for using the rebate of up to 12,500 under 87 capital A. And one of the last planning points that I'd like to take is that never think that planning is only what you see in front of you. As the caption itself mentions, you have to always think outside of the box. So there is in fact a CBDT circular itself of number 26 of 1955, which has been meaningfully relied in a number of judicial pronouncements. Basically, the point over here is, let's take Upendra uncle, an interesting illustration where I'm having short-term capital gain on shares, which is taxable at a flat rate of 15%. I'm having short-term capital gain on gold, which I sold. As you all know that short-term capital gain on other than shares, the rate of tax is the full rate, which is 30%. And I'm having a short-term capital loss, or I'm able to generate a short-term capital loss on a few shares or scripts, which I'm doing. The question arises is, what should I use this loss against? Should I use it against the 15% capital gain on shares, which is taxable at a flat rate, or the 30% capital gain on gold? Which of the two should I use? Now, obviously, if you were the professional, you would like to use it against the 30% of the gold short-term capital gain to reduce the amount of gain. You can meaningfully do this because, as I said, there is no embargo which prevents you from doing it. The capital gain, capital loss of short-term can be used against either, and therefore I have put taxpayers should wisely choose what to set it off against to reap maximum tax benefits. I've broadly tried to cover points or aspects of interesting issues relating to capital gains. I would just like to take again a last thought process before I open up the floor for questions. Don't think outside of the box. Think what you can do with the box. So this is again a thought process which I'd like to leave you all with. Thank you so much for the patient hearing. I'll open the session for questions or any other comments which the viewers may have. Thank you to the organizers, and thank you everyone.